Well, good afternoon from London. This is Michael Mainelli at CN, and I'm delighted to introduce today's FS Club webinar. And we're thrilled to have Andy Sloan dialing in from Guernsey in the Channel Islands. Andy is the founder of the International Sustainability Institute in the Channel Islands, and we'll be hearing more about that during the course of the call today. But the exciting thing about today's webinar is Andy's here to talk to us about the unsustainable cost of the EU's sustainable finance regulations. And we've had a few sessions dancing around this topic a little bit, but Andy's going to hit it kind of right up the center. Why are we spending so much to achieve something which there are simpler ways to attain? Anyway, you'll know me. I'm Michael Mainelli, one of the directors of Yen, and I'm only able to introduce so many of these webinars thanks to, may I say it, the generosity and tolerance of our sponsors, whom you see before you, who allow us to range widely and freely as they themselves come from across the globe, and we tackle all sorts of subjects to do with technology, economics, and finance. And today is very clear. People talk about the existential threat of climate change. Everybody wants to do something about it, ourselves included, but sometimes we may not be doing the right things. Perhaps we're tying our shoelaces together as we try and achieve our objectives. Now, today's format will be familiar to many of you who have come to FS Club before. My job is to get out of the way as quickly as possible and hand you over to our expert, Andy. Andy is going to speak for about 20 minutes, but the great thing about these sessions is, in fact, the Q&A. So 3 quick questions out of the way. The first one is, yes, this is being recorded, and yes, it will be posted probably just before the weekend. So, you know, on Saturday or Sunday at the barbecue, you can get out your popcorn and watch Andy and his subject matter. Yes, indeed, the slides are available. In fact, you'll find in the chat room they've already been posted. So if you have a point of detail, you can go back on that. But most importantly, these are interactive sessions, and Andy is here with me to do Q&A. And it works in the simple way that you type some questions in, and I'll feed them into a conversation with Andy. All of your questions, comments, observations, links you'd like to point out will be sent to Andy with your email attached to them so he can answer you directly. So if you just want to thank him or say hi or get in touch for some other reason, we'll make sure all that gets to him as well, although his email is also available. Now, just before we got going, Andy has 3 poll questions for you, but we thought we'd kick off the first one before we let him have the chair here. And the first one is, you know, how concerned are you? Quite a few people online today. So how concerned are you with the costs of regulatory compliance with EU rules on sustainable finance? Not a problem, a little bit, quite a lot, a heck of a lot. What are your thoughts? Now, Andy, one of the great things about the FS Club audience is that they're very shy, and over 50% have already voted. So, I'll give them just a few more seconds to get the vote in. We're already up to 3/4. As you can tell, people here really hold back on their opinions. And with that, Peter, if I may ask you just to display the result, what we're seeing here is, yes, there is genuine concern on the cost of regulatory compliance, although 10% say not a problem and 10% say a lot. A bit and quite a lot is 80% of the audience. So with that, Andy, the floor is very much yours.
Thank you very much, Michael. If I go to the if Peter goes to that first slide, as it were, so that's the topic of today, and this report was published by the ISICI in March. Now it's our first paper, and it's getting quite a lot more interest as the summer is ending, and how should I put it? As the environment has changed, you know, suddenly costs are a bit more front and center, and people, you know, are going back to sort of good old-fashioned concerns for, you know, financial return, and so we're getting quite a bit of pickup in interest in the paper in recent weeks. Obviously, probably presumably helped by the marketing of this webinar, I'd imagine. But I did. It's you, as I may say, Michael. You summarised it, you know, perfectly. It was almost like, well, I'll stop there. I don't actually need to give the presentation. But I got asked a question on Tuesday in this interview by a journalist who shall remain nameless, and they said, well, surely if it achieves the objective, then it's all right, isn't it? And I said, well, look, setting aside whether this regulatory approach will achieve the objective, you know, squandering 2.5 trillion if you didn't have to wouldn't necessarily be common sense, would it? And I think particularly what we've seen from my perspective over the last decade, and this is what where the presentation probably will take us through, is my personal experience over sort of the 15 years since the global financial crisis, is that we've moved in a consensual creep of increasing regulations where groupthink has prevailed for the last 15 years, particularly driven by policymakers centred around Brussels, and that has been the driving force pre-Brexit. But also with the economic environment of monetary policy providing what has been effectively free money, the actual impact, and nobody's ever really questioned what we've been doing. And I very much think that there hasn't been a criticism or of any of the approaches that have been put forward, and what you have is vested interests cheerleading on what has been the proposed approach. So for me, this paper sort of does something a bit a bit out of left field. It says, hold on a second, is the cost of all of this worth it? And by the way, could somebody ask, how much is this going to cost anyway? Because one of the things I did discover as I went and did the research originally back at the beginning of this year is there wasn't any accompanying economic impact analysis in the traditional way, which is an amazing oversight, and I'll come to the reasons for why shortly. So for me, if we move on, Peter, I just take the opportunity to say one or two words about the International Sustainability Institute. Michael didn't say that. I'm based in Guernsey. I'm based in the Channel Islands. I've been here for 15 years, and effectively, I think I've got the set, as it were, in terms of the policy roles in Guernsey. I've been the chief economist for the government here. I was a director at the GFSC, so I was a financial services regulator. And I was director of strategy and deputy chief executive of Guernsey Finance, the promotional body. Now, I left all of that just over a year ago to pursue my personal interests, like a quasi-semi-retirement, as it were. I sit on the boards of a handful of financial services companies here, and are able to pursue the development of the creation of a think tank over here based around 3 different strands of sustainability. Because for me, sustainability isn't just the latest sustainable finance variant. There are fiscal sustainability issues that we have failed to address over the last several decades, as we're finding out now, and the good old-fashioned environmental sustainability, particularly when one is based in the Channel Islands. There is an awful lot of change that we could look to advocate locally, but that's for another day. But that's what the International Sustainability Institute was set up to do, to promote those 3 different areas of sustainability, develop sustainable research and thought. And I do this alongside, I run a small climate change consulting called Netherite and Gunville, which I'll refer to, which provides climate-based risk here in the Channel Islands. So the rationale of doing the research here was because, like I said, I've got the background in my personal experience is dealing with the European Union. I go back pre-Brexit, we were a 3rd country, so I spent an awful lot of time both with government and also as regulator dealing with the European Commission, particularly in that single rule book phase when lots of rules and regulations changed in Europe. We spent a lot of time lobbying on 3rd country issues. So I really didn't know my way around the introduction of new regulations in Europe and what the process was. And also had a bit of, I'd say, probably a bit of emotional baggage with it because I'd seen things happening and never been able to say, hold my hand up and say, hold on a second here, because I'd always worked with a professional interest, but I suppose I'm a free man now, as it were. So I decided to put this little paper together, which is on the website as well, the full paper. I think it comes to about 7,000 words. It's a short bath time read. Anyhow, so if we go to the next slide, Peter. So the synopsis, come here very briefly, is I like to structure things in the same way, but to tell you what I think up front is that the regulatory burden of the last decade we've sleptwalked into there. I mean, we can always remember Doug Flint going on at HSBC about his regulatory costs, etc., etc. But it's sort of there wasn't really a particularly good. We didn't hold the thin red line on this one. The regulatory costs just carried on creeping all the way through the last decade. And I think now, like I said, with the very much changing circumstances of the last 12 months, the focus now is on a lot of these activities, and people looking at what people are being asked to do and saying, look, is this really necessary? Do we have to do it in this way? Now, I sort of am a big advocate of sustainable finance in the generic sense, and for me, climate change mitigation and the IPCC targets is something I'm emotionally quite invested in. I believe in quite very strongly, and I would say that I looked at TCFD and I supported TCFD. My firms are formal supporters of TCFD, and I think that the simplicity of climate change metrics, albeit regulators can implement them in their own different ways. But I strongly believe that a less expensive using carbon emissions is a much more preferred route than the costly route of the way that the European Union has decided to progress. So that's my synopsis. If you go on, Peter, to start off with regulatory mandates, I think I mentioned it a couple of times already that yes, I have been a regulator for my sins. And if we go back to 2008 to go back to the twin peaks of regulation, when the regulatory models got overhauled, the FCA came into creation, and the various mandates were split. But broadly speaking, when you go regulator, you get the Regulatory Handbook 101. You get sent to the FCA to learn about regulation as she is taught from Blighty. And basically, you've got two areas: conduct and prudential. Basically, that's the two aspects. You are protection of investors, making sure the conduct of financial services firms is kosher, good, and proper, and people, jolly good eggs, and don't tell porcupines, don't mislead people. And then you have prudential, which is basically to make sure the financial institutions are ongoing, growing concerns and can keep going. They don't explode in a puff of smoke, and therefore people's money goes with it. That's it. That's the two rationales for regulation broadly as is. After 2008, we snuck in a new one, which is basically macro-prudential. And I have views on this, but basically financial stability became the, if you remember the days of Eddie Waring and Stuart Hall doing Jus sans frontières, and this is Stuart Hall playing laughing away, saying, they're playing the macro stability card, Joker, ho, 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 and all sorts of things have been done under the name of financial stability in the last 10, 15 years, which are just nothing really more than basic economics. But if regulators have used financial stability, they haven't been able to be questioned, and on their merry way on they go. Which in some ways is how TCFD got introduced to the world, by invoking a financial stability risk, which Stuart, I can't remember his name now, the chap from HSBC that lost his job when he did that presentation at the FT, and he's an ex-FT journalist. It's a really good, if you want, really good presentation if you catch it on YouTube. But basically, he probably went a little bit too far. But this notion that these risks are going to materialize and lead to a repricing of assets so quickly as to create financial stability issues is a little bit of a stretch. But anyway, it is what it is, and it's that mandate that was used to ask people to produce metrics around financed emissions, and so therefore the financial regulatory mandate was used for a policy purpose that was slightly removed from its primary purpose. So all well and good, but then the EU Sustainable Finance Programme comes along, and the mandate that was used there, it's basically a spin out of the Capital Markets Union, which was on Jonathan Hill's baby. I still remember I was lucky enough to go to the launch in Brussels of this and hear him sort of speak about the rationale for doing the Capital Markets Union. And what he wanted to do was create capital markets efficiency, harmonisation, increase capital flows. That's the purpose of this regulatory dossier. And so if you go back to it, Sustainable Finance, or SFDR, is effectively a regulation designed to increase capital flows and to create capital market efficiency. And I'd suggest it does neither, because of the significant amount of costs And I don't believe we're seeing any increasing inflows into the areas that was originally intended. So, but that's the mandate. And I said earlier about the cost is because it was a capital market efficiency mandate, the actual economic impact was never actually undertaken. In fact, if you go to the regulatory technical standards, the EU, the ESA's final draft of the RTS back that were published last year in 2021, it says in there, it says, it was such a rush, we didn't have time to work out the the cost of the alternative policy options. You go, well, that's all right then. It's fine as you are then, guys. Don't worry about it. You get a free pass because it's sustainability. You don't have to worry about it. But it's shocking. If it was anything else, people would be up in arms. But no, we're all in favour of financial stability. Sorry, sustainable finance. So don't worry about it. But we should worry about it because regulatory costs. I mean, I'm sure everyone's been reading today the same newspaper reports as I have that the standard of living is now back to levels last seen in 2003. So it's just a cool 20 years where we're no richer than we were. And I don't think I'll be alone, but I have noticed the costs in finance, be at a step level above what they were in 2008. I can see, I can even disentangle it from the inflationary effects. I know that it's about 20–30% more costly to do business than it was in 2008. And so I can see and feel the cost increases. Sorry, Peter, if you can just go on to the next slide. Oh, it's a bit early. I made the case, I think. Because here's the regulatory costs. And Michael, you'd appreciate that I dug out an early report from Zien on AML costs. Now, because I came across that back in the day when I did some research on AML costs in the Channel Islands about 8–9 years ago, actually. It wasn't the first time I'd come across it. But if you look at the tiny fraction of the estimate of what you worked out, what you thought it was back then, and it's very quaint, it's very sweet and naive in a way, looking at we're writing the report about, the costs, where are they sort of thing. And if you look at I nearly fell off my chair when AML Oxford Economics estimate of costs was 40%, AML at 40%. And even I went, oh, no, come on, it cannot be AML 40%. And this is, and the fact that nobody ever questioned it just seeped into the ether, but it shows you that there is a huge scale of difference to what it is today.
Exactly.
Now I'm looking at that report of Channel Islands costs for AML in 2013, and 20%, I would vouch for that being a real number back then. And so, you're looking at now 40% from Oxford Economics, which I think is out by a little bit. But you look at also the costs, and I worked this out from the estimates I was about to show you, the incremental costs of European Union regulations. This is as admitted by the European Union. So the European Union admits, if you go out and add up all of their little bits of reports, their ex-post reports that they've done, and you say, yes, they admit that they increased the cost base by at least 10% with the regulations they imposed in that 10 years. And that's the iceberg. That's the admitted impact as opposed to the invisible impact, which is probably a factor of several times. But the backcloth is we've already gone through this huge increasing cost in regulatory cost environment, and then this is the environment that a whole new range of regulations was introduced that is all pervasive, that will impinge on every aspect that we're doing, without anybody giving any thought whatsoever to the cost effectiveness of it all. And that happened because this was the environment we were in. Regulatory cost increased, it's just accepted. So, I mean, we had a decade of what? FATCA, AML, the global financial crisis, the new prudential rules, the single rule book in the EU, and then it was just another regulation, another regulation, another regulation. So, Peter, if you go on to the next slide now, one thing to sort of try to help people sort of conceptualize the impact of a regulatory cost is if you think every time about what it would cost to implement a brand spanking new one. And this is research, and I apologize, I haven't put a reference on here. I think it's one of the big four. But the typical breakdown of costs of an industry-wide new regulatory cost. Consultants usually chip in with about a fifth of the costs. Project management, best part of a sixth, and IT just over a third, just under 40% is usually the cost of compliance or the cost of increasing a new regulation. So this happens each time a new regulation is introduced. And the reason why this is important is if you look at the IT costs and the consultancy costs as components of the incremental regulatory costs, and this is the one-off cost as opposed to the ongoing BAU type costs, is the data and the IT systems and the involvement of the granularity of what's going to be required is phenomenal. In terms of, you go to the sort of the Sustainable Finance Circus conferences, and people say, "Oh yes, we all appreciate data as an issue." The data as an issue, could we just stop and figure it out first, rather than increasing the requirements? I gave a presentation to a client in the summer where I explained that regulators will make these decisions without any notion of how these things are going to be worked out. And they were like, "Really?" I said, "Well, you don't think that Mark Gunny was walking around knowing fully exactly how the financed emissions weighted average cost of a fiduciary based in the Channel Islands was going to be worked out, or how on earth it was going to be done, if the data was going to be collated from the investee companies? Just make it so." So anyway, but that's one methodology, an idea of looking at how where these new costs come from. And if you, as a rule of thumb, worked out that ironically, if you went back to all of the various different dossiers from the EU, this regulatory, the one-off costs usually come in about 1.5 times the BAU, which is quite strange really, because I think it'd be more than that, but the BAU is clearly quite a significant cost. Now, Peter, if we move on to the next slide. Like I said, in the preparation of doing these calculations, this methodology, working out the cost of sustainable finance, I went back and, like I said, I knew where to dig them out. These are the ratios of. This is the European Commission's own numbers, by the way. This isn't me working these things out. This is the numbers owned up to of the ratio of the actual cost estimates to the original cost estimates and the economic impact. So, and the reason why I was well aware of this happened is because of MiFID II. I remember fully well the number for MiFID II. It was something in the region of £470 million. This is the economic impact analysis in the European Commission's report. And I can imagine there are certain banks where they probably spent more money than that. Let alone the industry-wide figure for the European Union. But if you look at it, it comes in on the acknowledged numbers at 5.5 times that. In actual fact, that what we're saying is effectively 2.5–3 billion of costs across Europe. I would strongly suggest it's more than that. If you look at the operating cost of the European Union finance sector is something like 300–400 billion. Because of the sheer scale of the finance sector across the European Commission. So I'd imagine MiFID II costing just 2.5 billion is an underestimate. So, but anyway, my point being here is that it's usually out by a factor of 5 to 6 at least, maybe, and then some is what I'd say. And that's when the cost estimates are done. And like I said, for SFDR, it wasn't needed because it was a harmonisation mandate, and harmonisation, and it says this in the report, we don't need to do the impact analysis because harmonisation creates efficiency. And I kid you not, that's it. That is the telling argument. Harmonisation creates efficiency. We don't need to look any further. So moving on, Peter, to a couple more slides now. The methodology was two different models. Personally, I'm a macroeconomist by trade. My PhD was in monetary policy and macroeconomics, and so therefore I'm a simple man. I like minimum of 2 variables, preferably only one in my economic models. But broadly speaking, the actual methodology itself was a micro-based bottom-up model. 2 methodologies triangulated. One was simple survey, go out, ask several firms in terms of their estimate of costs, based on asking global firms operating here in Guernsey, as opposed to local firms serving local clients. That would be a bit of a nonsense. And then also triangulated against the construction fund first principles, looking at the firms that I personally work with, going through and working out the relative costs, and then looking at that model of the what typical one-off costs are, the pie chart, and then building those both up, aggregating them both of those different estimates against the two different methodologies of the cost base for industry-wide costs. One is looking at estimates of the cost of compliance across the finance sector and working out as a percentage of that. So saying, well, okay, it costs us an increase in 10% in our compliance costs, so therefore aggregated across the European Union is going to be this. And the other was aggregated using the estimates for the total operating cost, which is...
Andy, we've got a bit of a question coming up, I think, because we're going to have to move a little faster. We're sort of over time at the moment.
I think we're just about to the last slide, I think.
Yeah, so if Peter, do you want to pull up that question quickly there? So this poll was interested in the audience's thoughts very much on do you believe this EU regulatory burden is justified? Because it is there. So audience, possibly a slightly loaded question, Andy, but as ever.
I'm shocked. I don't think my questions are always biased.
Our audience is off to a cracking start as ever. And again, over half of them have voted, so I'll leave it open for just a few more seconds for some stragglers. That's great. And Peter's going to pull up the results now. Well, interesting, kind of a split there, really. Yeah. Almost 50-50, justified and not justified. But back to the close here.
Sure. And again, that's an interesting question, because if you go to the next slide, Peter, the question is, well, what's justified? People, I mean, is 2.5 trillion justified? Is it 5 trillion? Is it 10 trillion? And that's the point, is that if we haven't done any economic impact, if nothing was ever costed, how do you know if the costs are worthwhile? It was just a presumptive. And go back to probably the poll. It's a presumptive case. It's a jolly good objective. So therefore, it warrants the cost, presumably. But if I look at it and I say, in terms of when we came out with the estimates and going through those two micro-based methodologies, aggregating in two different ways and then triangulating, the cost looking at between 36 and 48 billion euros across the EU 27 per annum. So we're leaving Blighty out of these estimates. And that comes in a cumulative capital cost of 2.5 trillion up to 2050. Now, if I said to you, well, alternative, why don't you just report the financed emissions and use that as a proxy for whether you're a jolly good egg or not, and not worry about all of the different variables of gender, the gender diversity of the board of the operating company that the private equity firm has took a 30% stake in or whatever. You could probably save all that and put that into climate change. I mean, we're talking about, in terms of the funding of investment and renewable investment, that would go, I don't know, it's probably nothing more than 5 to 7% of the required capital expenditure per annum in Europe, but it's still 5%. It's still a reasonable chunk that could be put to better use. And economists are looking at, it's prioritization it's allocation of scarce resources, isn't it? And capital is supposedly scarce, but we've just come out of a decade where capital wasn't scarce. So people, I don't think, are necessarily in the mindset of worrying about costs. But anyway, that was the regulatory costs. And that was all the talking comes to that one slide. I probably should have started that one slide and given the backstory to it, rather than giving you the backstory and then giving the slide. But if we go, Peter, to the last slide now, I think we're at the sensible alternative. And I take this, no shame about nicking the slide from The Economist over the summer, because this is what we said in the paper, and the paper that we published, this presentation is based on, was published in March, and this is what we said. We said, actually, it's much more sensible to use your environmental as a proxy for everything else, and stop worrying about trying to record, everything and the kitchen sink. And it's like, don't believe me, leave The Economist. But that's where we are. And I think that was it. And in terms of conclusion, stick to TCFD and try and make that. And actually, the irony is one of the reasons I looked at this whole thing in the first place was in January. I was presenting at the MCLE, which is a US legal like CPD type conference that's done for New York and Florida-based lawyers, I think. I think it's in Knightsbridge. I've been going for a few years and giving presentations. And I got asked by somebody said, what's the difference between the UK and the EU? And I said, well, actually, the UK are stripping out the SDG and just concentrating on the climate thing. John Glenn trailed this back in 2021, I think, or 2022. Remember, industry was up in arms. The Investment Association was, oh no, stick to the European Union. It's much more sensible that we have the whole same single rules. Well, yeah, well, it's self-interest. It would be much preferable if we had cheaper, more effective regulations. But anyway, sound like a civilized loon there, eh? But
we've got.
I can't see why 2.5 trillion is a good. It's worth it.
Yeah. Well, I think this is it. You know, and in fact, it pervades so many other areas of regulation. Really, I've done a lot of work over a few decades now with the Better Regulation Commission and its antecedents and descendants, and you have a lot of business people constantly complaining about regulation, and actually frequently they're talking about tax and tax compliance. You got a lot of people talking about the incredible burden of regulation to the EU, the so-called bonfire of Brexit, which and the Brexit dividends, which have never materialized. You've got a huge host of people who find regulation a wonderful, delightful, thrilling barrier to entry, and like to talk it up. So it's a tough area, this. But we've got lots of questions here, so let's get cracking. I'll start off with Bob McDowell, a fellow Channel Islander. I think you know Bob. So Bob's over in Alderley, you're in Guernsey, so not too far distant. Bob is kind of, do you detect a quasi-religious zeal in the stacking up of costs and standards? And do you think that ultimately regulatory costs and standards will be curbed by a political revolt, mass non-compliance, or external events? It's clearly there has to be a break point. This can't go on forever.
I think it's Bob. I mean, we've sort of had this conversation. I don't know what we're waiting for. I mean, like you said, Michael, Brexit, there hasn't been any sort of honing down as yet perceived of any regulations. Although, I'll be frank with you, I think on the UK's FDR, it's the first. But even then, it's probably of an ilk of regulation that you wouldn't have imagined possible in 2007. Because the degree of prescription is still a bit much. But at least it sticks to just the salient points, But I do think, and it's sort of lamenting the way of the world in grumpy old men. But at some point, people are going to realise that we're basically destroying capitalism. We're putting on huge amounts of cost on the cost of capital. People have got to wake up and smell the coffee and appreciate that 15 years has been spent where there's been no consequences for anything. And at some point, those consequences are going, I'm talking about the free money decade of quantitative easing that's created this environment where what do you need to worry about costs for? I mean, the money is just all flowing into privately held assets anyway, so who cares? And the music's stopping. I don't think it's stopped yet, but the music is stopping. And governments are, unfortunately, being cheerleaded on to use fiscal largesse for just about anything, any problem if they've got wine in it. No, stop that. I do sound like a nutter now.
Well, John Deverell is a little bit skeptical here. I think he's got a point. He says, how sure are you that nothing was costed? His daughter works in this area in the EU, and he'd be very surprised to find out nothing was costed. And in the same, name, thank goodness, in broad terms, the EU is holding firm's feet to the fire.
Well, I'll dig out the quotes of the European Commission's reports. If you look at the regulatory technical standards that were published, like I said, last on the 21st, it said we didn't have time. We were in such a rush. We didn't have time. It says that we didn't have time to do this, to look at the alternative policy options, and because it was a harmonisation objective, as opposed, it wasn't seen as creating something necessarily new, because it was a harmonisation objective. They didn't put in that barrier, that economic impact barrier. Although I'd be frank with you, it doesn't seem to make much difference, and you can be out by a factor of 5 or 6 times. It doesn't matter. The whole point is that it's a mindset, and this comes to probably Bob's point. I've had the advantage of being in Brussels. I've been there in the Berlaymont when the big lecture theatres, new policies are proposed, and everyone's around there, and it's not a diverse group. And I live in the Channel Islands, so it's such an undiverse group. It's painful, and the representatives of the other stakeholders are usually the people that are already that are being financed by the European Commission's euro dollar, tax dollar, or tax euro, I should say. There are people who represent the representative of the European Consumer Association. Who's that then? Couldn't name them, but there is that person there in the room, and there are insiders in the bubble making these rules up, and without real reference to any notion of and industry groups and sort of companies just give up. They're not going to win the principle of that. The Europeans do regulation in a very costly way. That ship sailed years ago. If you go back to AIFMD, I remember AIFMD when it was first introduced. Oh, but now look at it. How many new sort of extensions were introduced when it was revised? The scope suddenly went huge. Why? On what basis was that? That was based on financial stability. What interest of financial stability is it about how diverse the board is?
Now I'm going to ask Peter to pull up the third poll while we're just waiting, because it relates to a couple of questions here. We've got a question really. So folks, do you think a straightforward requirement to publish finance emissions and variance, a la the EU's Task Force on Climate-Related Financial Disclosures, TCFD, would be a fairly simple and preferable approach? And while you're answering that, and the audience is out there, I've got a comment really from Kenneth Toombs. Why would TCFD principles improve consumer trust when such soft, self-regulated methods have clearly failed in the past? And Gabby Glassener Chipotle is, what happens to company TCFD disclosures? Are they actually reviewed by the regulator? And Peter's just going to plop that result up there so you can see that the audience believe broadly 60-40 that TCFD publication is preferable to some of this regulation. So, Andy, over to you.
So, remind me the first question, because the second question was about where the TCFD reports to. What was the first question?
Yeah, are they actually looked at by the regulator? And Kenneth, in a related way, is why would TCFD principles improve consumer trust when such soft, self-regulated methods have failed in the past?
Well, and here's about consumer trust. I'm not entirely sure why the European Union SFDR is improving consumer trust anyway. I mean, it's just a whole rampant bureaucracy of principal adverse impact statements of the entity, the product, and who reads this stuff? The FCA hate PRIPs. The PRIPs were never designed to do what they were supposed to do. There's a whole pointlessness around. If you look at what the requirements are and the costs of deciding what to do, trying to figure out if you're doing the right thing, employing somebody to ask them if you're doing the right thing, then trying to get the data to publish all of this stuff. It's how is that helping consumers? It's just a layer upon layer of what I'd call Golga Frinchian Arc B activity. There's no need for any of this stuff. If a report, if you had one variable, I like the implied temperature rise, the ultimate, because it gives something that's a simple, easy to follow variable. The reason why finance or capitalism works is because rate of return, the return on capital works because it's one variable to follow. You can understand it. Lots of things will go into determining what it is, but it's one measure, and I can follow that. One measure, one objective. I remember I'm a monetary economist, but you get taught about the number of objectives and the number of levers. You talk about SFDR, the number of objectives is how do you optimize this welfare function that has 40 or 50 different variables in it? It's just not possible. but yet people won't admit it, and they're self-interested to produce that information. I don't see how that helps consumers. Having a simple metric, a published metric of, okay, so weighted average carbon intensity means nothing to people. Well, it will do to the experts, they'll be able to relay it on, but the implied temperature, the rise of the asset, which I strongly believe, in fact, we wrote a paper recently actually advocating that as a move, that all assets should come with that. What is it? And that would give you a heuristic, enough information to take a heuristic view. That would be enough. And the irony is, talk about the TCFD reporting. Yeah, I laugh about that. No, because it doesn't get reported to anybody, does it? That's the point. But do you think that the regulators sit over and go through the SFDR? Yeah, occasionally. But what will happen? It's not like FATCA where your returns are sent to the IRS, and so therefore everyone made sure they were accurate, or not, as the case was in a few painful instances. But they will be at times reviewed by regulators, and it's something you're going to publish it. It's going to be part of your annual report. It's part of the annual report, it then gets audited, so therefore it's qualified. So therefore, the requirement for it to be correct and true, the duty of that should be sufficient on its own. Do you know what I mean? You shouldn't need, but I have seen people suggest this, you don't need another set of regulators and supervisors checking the people that are providing the data. At some point, people have got to be allowed to do stuff. Now, we can't all be supervisors, which is sort of like the way, to that point. But no, the short answer is no, there isn't a requirement to publish it and deliver it to anybody, but the sheer dint of your public information that you're producing about your company, let's be old-fashioned about it. Let's hope people are true and honest.
Well, we've got time for one final bit, and I feel that John Deverell has made a number of submissions, which you'll be sent all of them. So, John, you're out there. I will get them all to Andy, but not in the next 2 minutes. But I'm going to try and summarize. I think he's got a point. You spoke earlier about, the idea here was increased capital flows, and John makes a number of points about Gen Z and the millennials, really wanting to do the right thing. And a good return on capital is increasing in line with investments that are ESG compliant. So we've got a few things there. But I think John makes a really good point of, what is the purpose of capital markets if capital isn't being directed to problems that we care about solving? And here you're sort of recommending a focus very much on the carbon, but this wider ESG stuff clearly does have adherence. And any thoughts on that?
Well, I agree with John's premise. People do want in the 2022 world to be aware that their investments are going towards good causes, as it were. I don't think that the European Union's approach to regulatory prescription helps people in that respect. You're an investor, go and look at prospectus and invest in companies that are aligned to your views, or aligned to objectives that you support. It's not much more difficult than that. What the problem is, the whole regulatory, the marketing circus makes it so confusing and costly to do what should be a straightforward ask, in my view. Yeah, I mean, you can get lost in the whole marketing, ESG, sustainability. If you go online, you can just lose yourself.
Well, I think that's probably a good place to pause, because I tend to agree with you that there's a genuine issue here where if these things are so simple, then, tell me and be done with it. If they're so complicated that only experts can do it, then who's doing the investing here? Is it me or the experts? We do seem to have, as I've used the phrase a few times, we do seem to be creating jobs for the boys and girls in the ESG space, and surely that can't be right. I personally, on the specifics of carbon, believe we haven't put the effort that's required into what we agreed in 1997, which is carbon markets, and just make them work. We we do that for many other pollutants quite successfully. So this idea that it doesn't work is silly, but I do think the wider ESG area does lead us to a plethora of numbers, none of which we can balance off with each other unless they've got financial translations, in which case you then don't need the ESG numbers. So you go in this kind of peculiar circuitous loop. And I think it's been really good that you've highlighted it. I think we could have a wider session, frankly, not just on ESG, but on the tensions in regulation and how, the answer, I think it's Andrew Hilton at CSFI has always said something along the lines of, the answer to every regulatory failure is more regulation.
Yeah.
And we don't seem to be learning from that either. But it's been enjoyable and very kind of you to come on and, make a point of view that frankly is not flavor of the month.
No, I did. Thank you very much. I enjoyed it too, and I did have a friend that works in the civil service, not in Guernsey, and I asked them what they thought of the report. I said, well, I agree with all of it, but couldn't say so in public.
Yeah. Well, look, it remains for me to thank three groups of people. Firstly, our sponsors, whom you can see here before you. Secondly, the audience. Yes, all of it will be sent on to Andy so he can respond to you directly. But as you'll gather, we have a number of events coming up. As ever, please do mostly just go ahead and look at the website. But you will see that there are quite a few related subjects to ESG and green finance, both in the past and in the future. Not least on Monday the 12th, we're going to be looking at climate change and global fires. It's more interesting than you might think, believe it or not. And then Dead in the Water, what happens when organized crime targets the City of London. So lots coming up. But it remains for me mostly, I think, to thank you, Andy, for preparing today's pitch, for the report that you've done on the subject, which I think is extremely important in terms of pointing out that this regulatory burden does need to be addressed and clarified. And we really appreciate your time. So in time-honored FS Club fashion, our sustainable technology for applause in this day and age. I'd like to thank you very much and hope to hear from you again.
Take care, Mike.